In the year 301 AD, the most powerful man on earth issued a decree: sell onions above the legal price, die, buy bread at a premium, executed, hoard grain in your warehouse, death. Emperor Diocletian believed he could legislate economic reality. He believed that by simply commanding prices to freeze, inflation would obey. He was wrong, and the blood that followed would prove it. 18 centuries later, a similar drama unfolds. You feel it every time you enter a grocery store, every time you pay rent, every time you fill your tank. Official statistics tell you inflation is under control. The Consumer Price Index reads 3%. The Federal Reserve declares victory. Yet your lived experience tells a different story. Food prices have risen 24% since January 2020. Shelter inflation remains stubbornly elevated, contributing more than 2/3 of core CPI inflation. Energy prices spiked nearly 50% from January to June 2022 alone. Politicians offer explanations. Some call it greedflation, corporate greed, price gouging. A 2023 YouGov poll found 90% of Americans blame profit-seeking businesses for rising prices. The proposed solutions sound familiar: price controls on groceries, rent caps on housing, and something new, something unprecedented: programmable central bank digital currencies that could limit where, when, and how you spend your money. The pattern is ancient. The consequences are predictable. To understand Diocletian's failure, we must understand what created him. The Roman Empire of 235 AD was dying. For 50 years, emperor after emperor seized power, only to be murdered by the next ambitious general. The military demanded payment, more soldiers, higher wages, endless wars on every frontier. The treasury ran dry, but the mints never stopped. The denarius, Rome's silver coin, had been the backbone of the Mediterranean economy for 3 centuries. Under Augustus, it contained approximately 98% pure silver, a soldier's daily wage, a family's measure of grain, real value backed by real metal. Then Nero lit the fuse. In 64 AD, after the Great Fire of Rome, he needed money. Not just some money, enormous sums, to rebuild the city, to construct his golden palace, to pay for his ambitions. So, he debased the currency. The silver content dropped to 93%. He minted more coins from the same amount of metal. Instant wealth, or so it seemed. The precedent was set. Subsequent emperors followed. Vespasian reduced it to 89%. Trajan pushed it lower. Marcus Aurelius accelerated the decline to about 75%. By the reign of Septimius Severus, around 200 AD, the denarius contained barely 50 to 60% silver. Then came the catastrophic collapse. Under Caracalla, in 215 AD, a new coin emerged. The Antoninianus, supposedly worth 2 denarii. Yet it contained less silver than 2 actual denarii. The same trick Nero had used, magnified. By the time of Gallienus, in the 262nd, the Antoninianus had fallen to 5% silver content. Some coins contained as little as 2.5%. Essentially, copper with a thin silver wash, a lie you could hold in your hand. The effect was mathematical, inescapable. Between 200 AD and 300 AD, the inflation rate in the Roman Empire reached an estimated 15,000%. Consider wheat prices in Egypt. The papyri record the devastation with cold precision. In the 1st and 2nd centuries, a measure of Egyptian wheat sold for approximately 6 drachmas. By 276 AD, that same measure cost 200 drachmas. By 324 AD, it reached 78,000 drachmas. By 334 AD, over 2 million drachmas. The same grain, the same farmers, the same sun over the Nile. Only the numbers changed. Because the money changed, as one Roman historian summarized, 1 Roman pound of gold was valued at 72,000 denarii in 301 AD. A sum nearly impossible for any Roman to physically possess. This was not greed. This was not market manipulation. This was mathematics. When you increase the supply of money without increasing the supply of goods, prices rise. Always, without exception. In Rome, in Weimar, in Venezuela, in Washington, the mechanism is identical. Only the technology differs. Into this chaos stepped Diocletian in 284 AD. He was not Nero. He was not a madman or a fool. He was, by all accounts, one of the most competent administrators the Roman Empire ever produced. A soldier of humble Dalmatian origin, he rose through the ranks on merit. He recognized that one man could no longer govern an empire stretching from Britain to Mesopotamia, so he created the Tetrarchy, 4 emperors, 2 Augusti, 2 Caesars, each responsible for a quarter of the realm. He reorganized the provinces. He doubled their number from 50 to 100. He separated civil and military authority. He built new administrative capitals closer to troubled frontiers. He reformed the currency, issuing a new denarius that was frankly copper, ending the pretense of silver coinage. Intelligent reforms, rational administration, yet inflation continued. In his own words, preserved in the preamble to his edict, Diocletian blamed unbridled avarice and raging greed. Merchants who hoped for bad harvests, speculators who controlled the seed supply, profiteers who exploited soldiers purchasing supplies. His diagnosis was wrong. His prescription was catastrophic. Between November 20 and December 10 of 301 AD, Diocletian issued the Edictum Depretius Rerum Venalium, the Edict on Maximum Prices. It was the most comprehensive attempt at price control in ancient history. Over 1,200 products, raw materials, labor, services, maximum prices for wheat at 100 denarii, maximum prices for barley, for wine, for olive oil, for pork and beef, for silk and wool, for the daily wage of a farm laborer, for the monthly fee of a teacher. The edict survives in fragments, stone inscriptions found across the eastern Mediterranean. The longest piece of legislation from the Tetrarchy. A monument to administrative ambition, the enforcement clause was simple: death. Not merely for the seller who charged above the maximum, death also for the buyer who paid the illegal price, death for anyone who hoarded goods, withdrawing them from the market. In the emperor's reasoning, the penalty for causing need should be even heavier than the penalty for exploiting it. What followed was recorded by Lactantius, a Christian rhetorician who witnessed the aftermath. His account, preserved in De Mortibus Persecutorum, chapter 7, is damning. Then much blood was shed over trifling and cheap articles. Through fear, wares were withheld from market, and the rise in prices became much worse. Until after the death of many men, the law was through very necessity rescinded. The mechanics of failure were predictable. Traders refused to sell at prices that meant bankruptcy. They hoarded their goods. They withdrew from the marketplace entirely. When goods did appear, they appeared in black markets, at prices higher than before the edict. Buyers, finding sellers violating the legal maximum, formed mobs. They wrecked shops. They killed traders. Over onions. Over cheap articles of no great value. The scarcity worsened. The violence spread. The economy contracted. Within 4 years, Diocletian abdicated in 305 AD, the first Roman emperor to voluntarily relinquish power. He cited ill health. The edict was rescinded. The lesson was clear, but history would forget. Now observe the parallel. In the Roman Empire between 200 and 300 AD, the mechanism was debasement, reducing the silver content of coins, creating more currency units from the same precious metal. The denarius declined from 98% silver under Augustus to 5% under Diocletian. The result, approximately 15,000% inflation. In the United States between 2020 and 2022, the mechanism was different in form, identical in function. Quantitative easing. The Federal Reserve's balance sheet more than doubled, from approximately $4 trillion before the pandemic to nearly $9 trillion by early 2022. The M2 money supply, the measure of currency plus bank deposits, surged from $15.3 trillion in February 2020 to a peak of $22 trillion by April 2022, an increase of approximately 40% in just over 2 years. Romans could not print silver from nothing, so they diluted what existed. Modern central banks face no such constraint. They create currency with keystrokes. The Roman response to price explosion, the Edict on Maximum Prices, price ceilings enforced by death. The modern response to stubborn inflation, greedflation rhetoric, proposed rent controls, calls for price caps on groceries. The enforcement differs. The outcome remains the same. Price controls cause shortages, not stability. This is not ideology. This is empirical fact established across centuries. In Nixon's 1971 price freeze, meat disappeared from shelves, and black markets flourished. In the Soviet Union, chronic shortages created meatless days in Moscow restaurants. In Venezuela, price controls on essentials led to national toilet paper shortages. The pattern is immutable. Consider the shape of the curve. Wheat prices in Egypt from the 1st century to the 4th century form a parabola, flat for generations, then an accelerating rise, then exponential explosion. The M2 money supply chart from 2000 to 2024 forms a similar curve, gradual growth for 2 decades. Then a vertical spike in 2020 to 2021. When the curves align, the conclusions follow. You cannot print prosperity. You cannot decree value. You cannot legislate economic reality. Diocletian believed he could command prices because he commanded legions. The Federal Reserve believes it can manage inflation because it commands interest rates. Both face the same mathematics. Increase the units of account faster than the supply of goods. Prices rise. Attempt to suppress those rising prices by edict. Goods disappear. The Roman soldier spending debased coins and the modern consumer spending devalued dollars share a common experience. Their currency buys less. Their standard of living declines. Their frustration becomes political fuel. Yet not all Romans suffered equally. While the denarius collapsed, the aureus endured. The gold coin, approximately 99% pure, it could not be debased without detection. Its intrinsic value matched its face value. Barbarian mercenaries, serving Rome's desperate emperors, demanded payment in auri, not in silver, not in copper washed with silver pretense, in gold. They understood what the imperial treasury pretended not to know. When Constantine introduced the solidus in 312 AD, replacing the aureus with a new gold standard, the Roman economy stabilized. The Byzantine solidus would maintain its weight and purity for over 700 years, an unmatched record of monetary stability. The lesson is uncomfortable but clear. In a high-inflation environment, in a regime of price controls and monetary manipulation, the most dangerous asset is cash. Currency that can be printed at will. Currency that can be debased by decree. The safest assets are those that cannot be manufactured from nothing. Gold, productive land, businesses with pricing power. The ability to raise prices without losing customers. The Roman merchants forced to close their shops had no pricing power. They were commanded to sell at a loss or not sell at all. They chose not to sell. They chose the black market. They chose to flee. By the 4th century, Roman citizens prayed for barbarian conquest. As one ancient source records, both poor men and rich prayed that the barbarians would deliver them from it. In 378 AD, Balkan miners defected en masse to the Visigoth invaders. Citizens fled to territories beyond imperial control, beyond imperial taxation, beyond the edicts that promised order and delivered ruin. The empire had become a prison, its walls built from regulations. Today, capital moves faster than legions could march. When Venezuela imposed price controls, businesses shut down. When Argentina froze rents, rental supply collapsed. When the Soviet Union fixed prices, queues stretched around blocks. But in the modern world, the escape routes are different. Programmable money, central bank digital currencies that could restrict purchases, that could impose negative interest rates on balances above certain thresholds, that could prevent spending on categories deemed undesirable. A digital edict of maximum prices, not inscribed on stone but encoded in software. Diocletian was not a fool. He was a brilliant administrator who reorganized an empire on the brink of dissolution. He created governmental structures that would outlast him by centuries. He was perhaps the most competent ruler Rome had seen in generations. And he failed. He failed because competence in administration does not equal comprehension of markets. He failed because the problem was not greedy merchants. The problem was debased currency. The problem was his own treasury. He tried to fix the symptom while ignoring the disease. Modern policymakers make the same error. They see prices rising and blame corporations. They see shortages and propose rationing. They see economic distress and promise controls. But the mathematics remain. 18 centuries after Diocletian's blood-soaked failure, the choice remains the same. You can expand the money supply, and accept the inflation that follows. Or you can control prices and accept the shortages that follow. You cannot escape both. Diocletian learned this in 301 AD. The question is whether we will learn it now, or whether, like the Romans before us, we will demand that our rulers cancel inflation by decree, and discover, once more, that emperors cannot repeal the laws of economics, only suffer the consequences of defying them.